Hello and welcome to episode 297 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, welcome back. How you doing?
I'm good. I'm very excited, actually, because we're doing an event, and I mentioned it last week, I think it was, on the podcast, and we're going to give a few more details on socials. So I'm now in a position to be able to confirm the title and time of the event. So the event itself is called Ethical and Sustainable Investing. Can it improve the world and your wealth? Now, it's going to take place on the 30th of November online between 7:30pm and 8:30pm. If you go to moneytothemasses.com/events, you will be taken to an Eventbrite page where you can register for free to be able to join that event online. Now, I'm going to have a panel, and on that panel will be Alice Ross from the Financial Times and also Moira O'Neill from Interactive Investor. Now, Interactive Investor are the second largest investment platform in the UK, and if you have been looking at ethical investments at any point, you will probably know that they're one of the leaders in terms of platforms in the ethical space in terms of research. So they've launched something called ACE, which is a short list and an acronym, which is pretty much a list of 40 funds that they have screened for their ethics. So you can use that tool to go down and look at this short list and look at these 40 funds and use that to be able to build a portfolio that could potentially match your own ethics. Now, Alice Ross has written an interesting book called Investing to Save the Planet, and she will be on the panel discussing climate investing. So in the event, we're going to cover everything. It doesn't matter about how much money that you have. It's about what you can do with the money you have when it comes to investing to make a difference to the world. So how does ethical investing work? How to start ethically investing? How to ensure your investments have a positive impact on society? How you can tackle climate change by changing the way you invest, and how your pension could secure your future and that of the world. And there's lots of other bits we're going to be talking about. And obviously people will know that I talk often about ethical investing, and I hold some myself in my 50k portfolio on 80/20 Investor. So I'm absolutely buzzing about that event. As I say, it's the 30th of November at 7:30pm to 8:30pm. You can ask questions that we broadcast live on Facebook and YouTube. So make sure you go to moneytothemasses.com/events and register. And we'll remind you again in next week's show. So I'm really buzzing about that, Andy.
No, I am too. It's going to be a great event, I'm sure. The last one we did on property was fantastic. And actually, talking about buzzing, I am absolutely buzzing about a review that we received this week. So would you mind if I read it out? We said last week, if you want to review the podcast, we will do our very best to read them out on the podcast the following week. So we had a great one this week, and it goes as follows. This review is well overdue. I've been listening to the podcast since February and it's fast become one of my favourites. I consider myself fairly finance savvy and used to think that Money Saving Expert was my one-stop shop for money-related matters. Well, Money to the Masses offers a whole lot more. I've been investing in stocks and shares for a number of years now, and I'm signed up to the 80/20 Investor as well. The subscription cost pays for itself when you look at how improved the performance of my portfolio is. It also helps take the stress out of investing, as the podcast and 80/20 newsletter insights add a narrative to my portfolio that really helps me understand its ups and downs. It's a long review, this one, so I'll skip to the end. Finally, the Money to the Masses community has been great for like-minded individuals to share and exchange finance-related queries and concerns. Damien has gone the extra length to respond to all of the questions I've asked, and I really appreciate it. Overall, it's a great podcast, and Damien and Andy are friendly and informative, and I trust that my finances are in good hands. So there we go. That was an amazing review.
That's a brilliant review. I think the name was Henry that left that review. Those reviews are a real positive for us. They're really motivating to keep doing what we do on the show, the podcast, the Facebook group that was mentioned in that review as well. 80/20 Investor says, please do leave them. It's not being egotistical. It's just the fact that we then know the impact that we're having for people out there, and the millions of people that we do help via the website, podcasts, and the various other services we offer. But it's great to have feedback as well, because it is, like I say, it's motivating, but also it does help us on the podcast charts as well, getting all these lovely reviews. So thank you very much, Henry.
I suppose we should get on with the podcast then. What is it that we've got coming up on this week's show?
So I'm going to do an investing piece about winter portfolio. So there's a seasonality to markets. Actually, there are a lot of peculiar trends that occur at regular intervals. So people people may have heard of sell in May and go away, but there's a trend that kind of feeds off that, which you can take advantage of and build a winter portfolio where basically you invest during the winter months and then you jump into cash during the summer months. And I'll go into more detail on the piece, but it was something we looked at just over a year ago in episode 244 of this podcast. So I'm going back to that reviewing because I actually talked about how you could build a portfolio exploiting this trend. And it's interesting to see what's happened if you've done that a year on. The other piece I want to do is talking about debt, and it's good debt versus bad debt. And I want to frame the idea of debt in people's mind. And it's quite a powerful mental process which will help people decide about whether to take out debt or not going forward. So it's good debt versus bad debt. And lastly, Andy, you're going to be finishing off with a piece related to energy bills.
That's right. I just wanted to cover off the three main winter schemes and grants that are available for certain people in certain situations. We're talking about the warm home discount, winter fuel payment, and the cold weather payment. What are they? Who can claim them? And how do you go about it?
Good. So I'll kick straight off with the winter portfolio piece. So as I mentioned last year on podcast 244, I talked about this idea of a winter portfolio. So go back and listen to that episode where I talk about it in more detail. But to just give people a quick reminder, there is evidence to show that between November and May, so if you invested on the 1st of November and jumped out at the end of April, they are the best 6 months in terms of performance for the stock market. And if you therefore go into cash during the summer, they tend to be the weaker months. If you do this winter invested, summer in cash and keep doing that, it can actually boost the performance of your portfolio, particularly in UK equities. Now, just to give a reminder, as I mentioned, research has shown if you went back over a 25-year period, if you'd invested £100 in 1994 and over the next 25 years you had invested in the FTSE 350, you would have £257. That's not including dividends rolling up. If you had done the winter version, so you invested between November and the end of April each year, then went into cash and then kept repeating that process. So invested in the FTSE 350, then cash in the summer, winter FTSE 350, cash in the summer. That £100 in 1994 would be worth, after 25 years, £341. It's a massive difference. And if you did the opposite, I mentioned this on the previous podcast, and you invested in the summer and you were in cash during the winter, then you'd only have £69. So there's a definite trend. And what I did last year with 80/20 Investor, I came up with two portfolios that exploited this trend. So there was a consistent winter portfolio and an aggressive winter portfolio. You can take out a free 30-day trial if you want to see that piece of research. I've updated it actually this week to look at what happened. So last year I produced these two portfolios, each with 5 funds in them. They tended to be biased towards smaller companies, interestingly, and those portfolios had outperformed significantly over the previous 10 years. And I picked those portfolios and said, let's look what happens going forward. A bit like when I did my perfect ISA portfolio, where I worked out the perfect asset allocation and said, right, now let's follow it into the future and see if it can keep making money and not lose money. You can go back and listen to the previous podcast where I talk about that particular portfolio, but it was something slightly different, but it was exploiting this winter pattern. Now, I built one of the portfolios, a consistent winter portfolio, by looking at the funds that had a 100% record of making money in the winter periods. I then had an aggressive version that had funds in it that made money in 9 out of the last 10 winter periods, and they had the highest average return in those winter months. And those two portfolios are quite interesting when you look at what happened this year, because when I went to review this portfolio and to see what it did this year, I thought this is going to be a disaster, because obviously we had COVID come along, a pandemic, and that decimated nearly everything. And if you've been watching markets and particularly listened to our midweek market show, the FTSE 100 is a laggard in the pandemic. US equities have rallied strongly. US tech stocks were doing well. And so basically, if you invested in the FTSE 100, for example, you would still be sitting on significant losses. I mean, until very recently, you were still down around about 20% from the pandemic highs. Now, I looked at these portfolios and compared them against the FTSE 350, which is the comparable benchmark they were meant to be tested against, and the FTSE 100 and the FTSE 250. Now, what happened? If you had been invested, the pandemic came along, you were flying by the time the pandemic came along, you were up 10%. And that's talking about only in about 2 months. By the time we got to February, you were already up that much in the winter months. But then the pandemic came and the world crashed, and the portfolios, just like the wider indices, fell around about 30%. What was interesting then is that you would have stayed invested in those UK smaller companies fund, principally UK smaller companies funds, until May, as the process dictates, and then you would have gone into cash. Because we had a decent rally, didn't we, from the March lows? But most of that rally in UK equities occurred between the 23rd of March and the start of May. So you actually captured most of that upside. Their markets pretty much went sideways until November, coincidentally. So by pure luck and fortune, the portfolios had largely tracked the market. So the FTSE 350 and the FTSE 100. In fact, they'd actually outperformed both of those. Where it lagged was the FTSE 250, which is more like the mid-cap range. But let's give you some numbers. The winter portfolio is down around 6% year to date, while the FTSE 350 was down around 7.5%, and the FTSE 100 is still down nearly 10%. The FTSE 250 had almost broken even. So you can see that the difference was that if you'd been in the FTSE 250, that mid-cap range had done well. And the only reason it had done better was because it captured a little bit more of the upside that occurred in the autumn in the 250, so the FTSE 250. In the FTSE 100 and the FTSE 350, there wasn't that uptick. So the portfolio did keep abreast of the wider market despite being in cash during the summer months, which was quite interesting. Where this gets even more interesting is what happened in November. And of course, again, if you listen to midweek markets, we've started having the vaccine news, and Pfizer, for example, came out with the first piece of good news on the vaccine front on the 9th of November. And the market went through a big rotation. So we had the very things that had underperformed during the pandemic started to lead. Cut a long story short, UK smaller companies had a rocket lit under them. And we saw some of the funds within those portfolios that I mentioned, the consistent winter portfolio that I built, really pick up. And we saw those portfolios rally more than 10% in a matter of days. So in November, therefore, we could be entering a period where this winter could potentially be positive for this idea. We had a poor winter last year for this whole winter theme, so exploiting this trend because COVID came along. Could we, ironically, be about to enter a really good winter for this theme because there's a vaccine that's arrived? So it's going to be the complete counter to what happened last year. So let me give you some long-term numbers. So if we're going back to November 2009, when the original piece of research I did started, the annualized return, if you had gone and done the consistent fund portfolio, now I haven't mentioned the funds that are in it, obviously, because that's for 80/20 investor members, that annualized return would have been 9.65%. Now you've got to realise that half the time you would have been in cash during the summer months. Compare that to the FTSE 350. The annualized return is 6.3%. The FTSE 100 is 5.7%. All of these have been invested for the whole time. They weren't jumping into cash, so they were 100% invested all the time. Whereas the winter portfolio I mentioned that had nearly 10% return is only invested during the winter months. And the FTSE 250, that is also up near 10%. It's 9.93% annualized return. The point is, the FTSE 250 over the long term has outperformed the larger caps. We know that smaller companies does tend to outperform over the longer term, but they are very volatile and they have periods of underperformance. But by using this winter portfolio idea, you can capture all of the upside while only being invested 50% of the time, which is quite incredible. And to pick a number, Sharpe ratios, people know I love the Sharpe ratio, which is a measure of the excess return you make given the risk you're taking. The higher the number, the better. For the FTSE 250, for example, the Sharpe ratio is 0.37. For the consistent winter portfolio, it's 0.56. So it's a marked difference. I go through all of the various different risk return metrics that you can do on a portfolio, and the winter portfolio does stack up. It does work over the longer term. Will it work every year? No, because obviously, as I've shown, this year wasn't a great year for the winter portfolio methodology because of COVID-19. But could this winter be different? And there is an aggressive version of the portfolio that I created, which was a little bit less stringent on the criteria. They didn't have to be so consistent, the funds that I picked. They could say only have made money in 8 of the last 10 winters, for example, but there's a little bit more risk involved in that. So if you wanted to exploit this trend in UK equities, it does seem to be the best place to try and do it is the FTSE 250. If you try and do the trend by just using a tracker rather than picking individual funds like I did, then I crunched the numbers. And like I said, if over the full term you had done the winter portfolio from the 1st of November 2009 with the funds that I'd suggested last year, you would end up with a profit of 184%. If you had done it with just the FTSE 250, you would have ended up with 147% profit. Now, the FTSE 250 generally, so that is just invested the whole time, was almost identical to the winter portfolio that I mentioned, up near 184%. But the FTSE 250 version of the winter portfolio is the one that created 147%. That's pretty good, bearing in mind that you are only invested half of the time. But this also points to another bit of research that I did previously, because when I decided, look, last year I mentioned one fund. It wasn't a recommendation, but the Fidelity UK Smaller Companies Fund was in that portfolio. If I'd just picked that fund over the last 11 years and just been invested in it between November and May and then gone into cash during the summer months and kept repeating it with that one fund, then my return over that 11-year period would have been 178%. That's the percentage profit. So that's almost as good as the full winter portfolio that I had of 184, 185%. But obviously the diversification benefit of having more funds is shown there because you would actually made more. Fidelity actually had quite a poor year in 2020. That's why that portfolio's been dragged down. But it points to another piece of research. If you compare those last numbers I just said, if you'd applied that winter idea to just using the FTSE 250, so that means FTSE 250 in the winter, cash in the summer, you would have underperformed if you'd picked a UK smaller companies fund. So if you'd used an active managed fund rather than a passive solution in that mid-cap space, you would have outperformed. And my winter portfolio, which uses all active funds coincidentally, is the one that performed the best. And funny enough, I went back and looked at another piece of research I did when I looked at individual sectors and which sectors do passives outperform active funds. So passive funds are ones that are run by basically a computer. They just track an index like the FTSE 250. Active ones have a manager where he or she will pick individual stocks and build a portfolio, a fund, and will obviously try and beat the market. Well, interestingly, active funds really do well and outperform significantly in the UK smaller company space. And it's interesting that this piece of research I've done that pointed towards that fact that exploit this seasonal trend, but you're better off trying to exploit it with actively managed funds because you've got two things coming aligned there. The seasonality, but one of the few sectors really where active funds tend to historically outperform passive funds.
Okay, moving on to the next piece then, good debt versus bad debt. Damien, what have we got?
So one of the things with money is that it's not simplistic. There are times in life where you have to take on debt. Generally speaking, debt is obviously negative. You're having to borrow money for some reason. You owe somebody. But debt can be positive. And the aim is that people listen to the podcast when they go and take out debt or borrow money, they try and work out whether it is defined as good debt or bad debt. And good debt is a debt that you take out that is basically a sensible investment in your financial future. So you will likely be better off over the long term by taking out this debt because you're going to do something with the money that's going to put you hopefully in a better position, and it won't tend to have a negative impact on your overall financial position. A good example is obviously buying a house. So having a mortgage on a house is a good debt because it's enabling you to acquire an asset, a roof over your head. It in time will grow in value and hopefully you will then start to pay the mortgage off over time and eventually you will get to retirement and you will have an asset that's worth a lot of money that you could potentially sell, downsize, or pass on to your next of kin. So a good debt will have a clear and specific reason, and there's also a plan to pay it back in an affordable manner. And normally a good debt will involve the person going and looking for the cheapest means possible of taking out that debt. So you'll get a mortgage with the lowest rate or an affordable repayment. So there's a definite plan behind the debt. So not all debt is bad. Some debt is obviously good. Like I say, student loan is another one. So student loans, we've done a podcast on it previously. If you search through the past titles, you'll find where we did a whole thing about student debt and how it works. But student debt, although it's a loan, the way you repay it is actually more like a contribution. So you don't have to pay the debt off. It is a good debt in that it can allow you to get a better paid job in the long run. It's not guaranteed, but there's a purpose. There's a means of being able to pay it back, and it's manageable over the long term. Investing in a business is another good debt. If you take out money to help grow a business, then there is a plan that this money will be repaid back over time by whatever it is, in this case a business, which you will grow hopefully into something incredibly successful. And I mean, interestingly, there will be people wondering whether car credits, a credit for or finance to take out a car, is considered good or bad. The definition would really be down to whether it's essential and it's affordable. So if you need the car, it's essential, but the payment is affordable each month, then it could be classed as a good debt. If it's just some luxury car that you're after because you want to look good and it's pushing you a bit, you can't really afford it, then it's defined as a bad debt. Now, talking of bad debt, the definition is really down to whether it's a drain on your wealth and whether you can afford it. But I suppose ultimately it's whether the item or asset that you're buying or whatever you're going to do with that money can pay for itself over the long run when it comes to that particular debt. So luxury holidays wouldn't count under that regard. Borrowing money to pay bills could be considered as a bad debt. I mean, it could keep your head above water, but in the long run, you've got a problem that needs looking into, and it may be you've got debt problems as well. Another good example is buying things that are perishable. And so if you buy things on credit that are perishable, then that isn't a good use of debt. And it's a good way of framing things that should you use your credit card to buy stuff. And if anybody's listened to this podcast or our YouTube channel, you've heard me talk about this 19-year sandwich idea. And it's simply that if you were 21 and you bought your £3 meal deal every day for a year, that'd be about £1,000 you'd end up putting on your credit card. If you paid the minimum amount on your credit card at a typical interest rate for a credit card in the UK, it will take you until you are 40 to clear that debt because of the interest that keeps rolling up. And ultimately, those sandwiches would have ended up costing about £6 each rather than £3. So that shows you the difference, and that's why that's a bad debt. Now, as a final point on this, the Money Advice Service gives some good tips to avoid bad debt, and they've got a checklist that you can go through. So if any of the answers are no to the questions I'm going to ask, then the debt is likely to be a bad debt. So have you shopped around to get the best deal? Are you borrowing money as cheaply as possible? Will you be able to cope should the interest rate rise in the future? Will you comfortably be able to afford any monthly payments? Will borrowing this money improve your finances in the long run? And do you understand the risks and what could happen if things go wrong? And finally, do you understand all the terms and conditions associated with borrowing the money? So if you answered no to any of those questions, then you are likely to be taking out bad debt. And as a general rule of thumb, always look to avoid bad debt where possible.
Okay, and that moves us into the last piece of the podcast. And actually, it's quite timely because I don't know if you've noticed, Damien, the weather has turned and it is absolutely freezing the last couple of days. We've had a mild November so far, but the cold weather is kicking in. So I thought it was a good opportunity for us to look at the grants and the schemes that are available for people to get some help. And even if it's something that you may not qualify for, you probably know someone who would benefit from it. So it's worth listening to the next 5 minutes so that I can explain the schemes that are available. So there's 3 government schemes that are available at the moment to help with the cold weather and being able to afford your energy bills. And they are the warm home discount, the winter fuel payment, and the cold weather payment. And I'm just going to literally go through each of those, who qualifies for them and how you can claim. So the warm home discount is a scheme that provides a one-off discount of £140 towards your energy bill through the months of September and March each year. Now, that discount is actually sent directly to your energy supplier. So you won't be getting that in the post as a check. You won't be getting it into your bank account. You need to apply for it. And if you are accepted, it will be applied directly to your energy bill by your energy provider. It doesn't impact any other schemes, and so this can be paid in addition to the other schemes that we're going to go on to. So you'll qualify for the warm home discount if you are receiving the guarantee credit element of pension credit, or if you're on low income or in receipt of certain means tested benefits. So if either of those are you or someone that you know, you may be able to qualify for it. Now, of course, your energy supplier needs to be signed up for this scheme to be able to benefit. So you'll need to call your provider and find out if they are signed up for the warm home discount. The next one is the winter fuel payment, which is an annual one-off payment of anywhere between £100 and £300. It's made by the government to qualifying individuals to assist with the extra fuel costs during the winter period. So if you qualify, the payment is usually made automatically, and that will be paid to you directly in November or December, and the payment isn't taxed and it doesn't impact any other benefits you may have. The winter fuel payment really is to help those of a pensionable age be able to afford that extra winter fuel, if you like, hence the name. So you'll need to be born on or before the 5th of October 1954, and you need to have lived in the UK for at least one day during the qualifying period. The date that you need to have been living in the UK is between the 21st and the 27th of September 2020. I think that's essentially, expats living abroad, living in Spain, sunning it up. It's to kind of probably eke out some of those. That's the qualifying week, and the payment is anywhere between £100 and £300. The amount that you will receive is depending on your age and your living arrangements. So basically, how old are you, and are you living alone or a care home? And there's a table, and you'll fit somewhere within that table. Now, all the details are on the article that we've got on the Money to the Masses article. We will also put a link to that in the podcast notes and on the podcast page. Usually you'll be automatically sent the money, but if you are one of those people that does qualify and you haven't received your payment, you can go onto the government website, and we've put a link on the podcast notes as well on how to basically start the process rolling if you haven't automatically received it. And the final one that we're going to cover is the cold weather payment, slightly different to the other two. This again is paid in addition to the other two schemes that we've mentioned, and it will pay £25 for each 7-day period of severe cold weather that you experience between the 1st of November and the 31st of March. Now, the payment is triggered if the average temperature in your area is recorded as or forecasted to be 0 degrees Celsius or below for 7 consecutive days. Now, the cold weather payment is in addition to the other two, as I mentioned, and the eligibility criteria on this one is quite complex. However, if you are receiving any of the following, then you may qualify. So you need to be receiving either pension credit, support for mortgage interest, income support or income-based job seekers allowance, income-related employment and support allowance, often called ESA, or universal credit. Now, even if you are one of those people, there's further supplementary eligibility requirements on 2 or 3 of those. So it's a little bit more complex. Head over to the article on our website and we explain exactly how you can do that and how you can apply for the cold weather payment. So that's it. There's 3 schemes. Hopefully I've explained effectively what they are. Go onto the website if you're unsure, and make sure that you let people know. If you've got parents, grandparents, friends that may qualify for these, make sure that they apply for them and get them, because it's getting cold out there and this can help afford those bills.
It's a great piece because you may not qualify yourself if you're listening to this, but you may know a parent that does. Whenever we've done anything online, maybe an article we've written about some of these schemes, people have got in touch and said, I didn't even realise I was eligible. Thanks so much. That's money in my pocket, help with the bills. But you may know somebody who could get help, whether it's a parent or a grandparent. But also you would have heard in there elements to do with universal credit. So there will be people who unfortunately may have lost jobs during the pandemic, may be struggling. There may be therefore help out there for them this winter, which they normally would never have thought to apply for, that may be able to help them if they're struggling financially. So it's definitely worth sharing. So I think that's it for this week on the podcast, Andy, isn't it?
Yep, that is it. We are done. If you want to contact Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. Don't forget, we have that Facebook community page. It's facebook.com/groups/money to the masses. Get involved and do, if you can, review the podcast. We'll read it out next week. And it really helps us to rise on up that iTunes chart.
That is it. The only thing to add is don't forget about the event. moneytothemasses.com/events is the web address. So until next week.
Until next week.